Crystal, what are some of the obstacles in getting a mortgage when you're self-employed?
Great question. So first, you need to be self-employed for 2 years at least. If you've been self-employed for 5 or more, we can use 1 year tax returns versus needing to average 2. But they say that you're not going to like your loan officer and your CPA in the same year, because when you're self-employed, you get to take advantage of all of these write-offs, but that can negatively impact you on the loan side. So if you take all these write-offs and yes, it lowers your tax liability, but maybe your income only shows, say, $20,000 for the year after all those write-offs, you're not going to qualify for anything on the mortgage side. So you have to find the balance of, hey, you need to pay some taxes like we all do, and maybe you need to write off less so that you can qualify for a mortgage. The other piece, though, is there are things that we can add back. So it's important that your CPA understands the mortgage side as well before you file the taxes, to see what things can we add back that'll give you the same tax deductions and not negatively impact you on the loan side. So for example, we can add back in depreciation, things like that. But I have clients that'll come to me and they're like, oh, I got to save $100,000 in taxes. I'm like, yeah, but now you don't qualify for a loan in a traditional loan. The good news is we do have other options though for self-employed that are big statement loans or profit and loss statement loans. There are different options out there that are available if you were someone who took those big tax deductions.